Well, g'day there, traders and friends, market enthusiasts right around the world. You are here with James on behalf of Pivot Point Trading as I sit down and bring you a very quick pre-market update as we move into the trading week beginning Monday, the 22nd of February 2016. As I take a look at the pre-market futures, it appears all three of the US indices are going to gap up to begin the trading session on Monday. We're looking at a market indice across the board of about a 1% increase. That puts the Dow Jones Industrial Average just above this resistance level here at 16,512. As I glance at the futures right now, it's sitting at 16,530. And this is very, very important because a lot of people are starting to jump on the bullish bandwagon. Much like the sentiment of the market towards the middle of January was very bearish, when we see price fluctuations and momentum start to shift again, you start to see the flipping of sentiment and the psychology of the masses who are transacting in the market. The problem is, though, is that a lot of people are looking at this most recent chart pattern, which is really formed throughout the months of January and February, and they're calling it a double bottom. Now, although it takes the formation of a double bottom, and I couldn't argue that whatsoever, the problem with the discussion of calling this a double bottom is that it's not showing up at the right location. Much like candlesticks, the candlesticks and chart patterns, they derive their meaning from where it is showing up or where that particular pattern shows up in conjunction on the chart, whether that is at support or resistance, vice versa, depending on whether that chart pattern or that candlestick pattern is a reversal signal, or if in fact it's a consolidational signal or a continuational type of signal. Now, the double bottom is what we expect to see at the end of a bearish trend, and it's what happens. It's one type of a reversal chart pattern which tends to reverse prices. It reverses prices on the macro type of time frame. It's not what we look at on the minor level or the intermediate level to say that, look, hey, the trend has reversed. So a lot of people again are looking at this and they're saying, well, this is a double bottom. We're looking at this market and there's a very good chance in their opinion that the market itself is going to break out above the November and the December recent resistance levels, which have established themselves from around that 17,000 figure all the way up to 18,000. When we got the breakdown from or towards the end of December 2015 into January, that sweet spot or the actual pivot point which we were looking at was 17,126. And the reason why I'm doing this recording right now is that I want you to refrain again from jumping into the complacency or buying into the complacency which is inevitable up and around these transitory types of periods when a bullish trend exhausts itself and we see the beginnings of what is most likely to be a very bearish primary trend continuing to the downside. As you can see on my screen right now, I have a red box. Now, this red box represents a resistance area, which I myself am looking at very, very closely, and also the people in that pro analysis class. We are not buying into the tendency or into the thought process whatsoever that this is a double bottom, which is going to result in prices breaking above around 17,750. As you can see, if I change to the weekly chart, and maybe, if I zoom out far enough, you'll see this for yourself. We have the 2009 lows, and this is really a projection all the way up to the 2015 high over here in the month of May. We've had the first primary bullish trend line, that's fan line number 1. That broke in the year 2010. As you can see, the trend continued. This is fan line number 2. That broke down in the year 2011. And since that, you can see this bullish trend has continued all the way throughout 2011. 2012, we didn't actually retest it in 2013. You can see that this red line extension wasn't back tested. It was in the year 2014 very briefly, and that was when we saw that parabolic move to the upside, which resulted in the 2015 sort of stagnant market just moving sideways. What makes this very important is that we broke down in the month of August. We've come back up. We've established the first lower high, what we call a macro lower high. And if I zoom back out into the daily, you can see that we're seeing consecutive touches, not only on the weekly chart, but if we go back down into more sort of molecular level, we have 1 touch, we have 2 touches, 3 touches, and then the fourth touch in the month of November, 5 in the month of December, or a couple in the month of December actually. Now this is projected over to the right, as you can see on this right arrow. So what I'm doing with people in that pro analysis class is that we're saying, look, we expect the market itself, the Dow Jones, the S&P, and the Nasdaq to continue bullish, but we're not getting carried away with the actual double bottom type of chart pattern, which a lot of people are calling for, as to the continuation of the long-term primary bullish trend as at the current juncture. So as I'm sitting down and recording this video analysis for you, it is pre-market again on the 22nd of February. It is a Monday morning. And I'm looking at this market and saying, sure, it's very valid, the chart pattern itself. However, it's not showing up too far into a bearish trend, especially during the transitory type of shift. The correction which we are looking for, and what the actual chart is really showing us, is that this is just the beginning, and ultimately these support levels which we've run into during the months of August, September, and most recently in January and February are ultimately going to fail. I don't like sitting down and actually speaking in this matter and speaking in this tone, but it's just inevitable that we are going to see this 15,323 or even a little bit higher up here, just shy of 16,000, ultimately break. And this is where we will see largely capitulation when this macro support level actually breaks. So right now we're just going through the motions. We're going through the ebbs and flows of the market. And if I change to the exponential moving averages or even the simple moving averages, generally what happens is once we get the definitive break and we get the cross below the simple moving averages, or you see the 100 cross below the 200 simple moving average, the market will come back up for the first time. And really this is the make or break sort of moment for the market. If you see rejection right around that 200 simple moving average, after of course the footwork which has been put into this market throughout the second half of 2014 and also throughout the entirety of 2015, this is a sideways moving market. And to see the market establish that secondary lower low, so not only the lower low in August and September, and again that failed lower high, and then to see the markets put in a lower low right now. Well, going back to the simple moving averages, once you see the rejection from that 200 and you see that first lower low over here, then we'll only, or generally in the past two bear markets, we'll see one other opportunity to position yourself bearish at the 200 simple moving average. So this is really the last gasp effort of the bulls which is taking place right now, and unfortunately the mass majority once again are going to buy into the complacency of this bullish move, and again it's probably going to be quite ferocious and parabolic to the upside. But what you're going to see is that this market is going to roll, it's going to fizzle, it's going to be sort of like that sugar candy which just dissolves in your mouth, where 1 minute it's here, and it may be some, the continuation of three white Marubozu candlesticks, and it may look awfully bullish. But having said that, it can change on a dime, and very quickly the gains which have resulted from breaking above 16,594 will all be given back, and the market again will plateau and absolutely nosedive again below the macro support over here at 15,500, give or take a couple of points. If you pay attention to the exponential moving averages as well, you can see that we've really struggled to hold above the 20 exponential moving average. Well, we have held above it most recently. Now we're really interacting with that declining 50 exponential moving average. What's very important to note nonetheless is that these are sloping down. So although we aren't in a bona fide trend at the moment, it isn't a trend which has completely established itself. We are on the edge of a cliff, so to speak. If we see the 10 cross the 20, which is what I'm expecting to happen, and of course even potentially the 10 to cross the 50, a lot of people again are going to be calling this a bullish exponential moving average cross, and they're going to be calling for the resumption of the bullish uptrend. Well, again, much like I was talking about over here in the month of October, heavily documented on this YouTube channel, again, this is what we call the slope of hope rally, a counter trend rally back into the primary downward trend, which will ultimately fizzle and fade much like it did in November and December. So all I'm doing right now is just speaking the truth and trying to update people on this YouTube channel nonetheless to say, look, we are expecting short-term this market to move higher, but the long-term odds of this market breaking above 18,300 on the Dow Jones Industrial Average are very, very low, if not practically impossible. Now, you never want to write off anything in financial markets. I understand that, but what I'm really trying to sort of portray right now is that as a trader and trading risk, you really want to be taking risk off the table and be looking for appropriate hedges to the downside. Now, on top of that, before I get into individual trades or even talking about the S&P and the NASDAQ, is that, look, we got the cross with the 100 cross the 200 on the Dow Jones Industrial Average towards the end of August, if not the beginning of September 2015. And what's very important to note is that we got the cross up here above 17,750. Well, if you pay attention to where the slope of both the 100 and the 200 simple moving averages are right now, at the current juncture, again, Monday morning, the 22nd of February, well, they're down about 500 points from the initial cross. So although they are bearishly aligned and they are continuing to move lower, this doesn't bode well for the bullish resumption of, the long-term primary trend, which has essentially ended when we broke down in the month of August. That is just another bearish indication, which we are seeing take place across all three of the financial markets. On top of that, we've seen long-term divergence establish itself, divergence which I've never seen before in terms of strength on an actual market. Now, if you pay attention to this, this is the Dow Jones Industrial Average on the weekly chart. you can see that since really 2013, the market again has been towards the end of this bullish move higher. But if you pay attention to the MACD, you have a look at this very strong divergence. As price has continued to make higher highs, the MACD has continued to make lower lows. Pay attention to this. This is a very strong sort of warning and alert signal generated by the MACD. This is the strongest signal in terms of a macro reversal which we can get, but only upon proper confirmation. It's sort of like the hazard light going on or your engine overheating, whatever you want to call it. It is just a major cautionary signal that the bullish trend is starting to exhaust itself. Now, on top of that, just because you see divergence doesn't mean you trade divergence immediately. Generally, what we want to look for is, again, confirmation below the break of the neckline. So if I zoom back out again and bring back my annotations onto my screen, I'll just right click over here, bring up my annotations and put them back on. You can see that once again, that confirmation in and of itself will be generated once the August and January and February lows are broken. So again, sitting down and talking about financial markets to you right now, although again, we're expecting this bullish continuation a little bit higher. And again, a lot of people calling for the double bottom, which we call winners. That's generally what you say when you see a double bottom. But once again, only at macro support during the end of a bearish trend. And we are nowhere near the end of a bearish trend. We're only at the beginning of what may be a major correction for the year 2016 and 2017. It's just important that you understand that. And if you're trying to sort of, try and produce these short-term little swings in price to the upside, really what you want to be paying attention to is the macro trend. If you understand the big picture of the primary trend, you can long-term position yourself, and then you can just hold on to those positions as the market continues in its primary trend. So I must ask you the question right now: which direction is the primary trend? Big question mark on my screen right now. Which direction is the primary trend moving in? And again, the answer to that question, as per the series of lower highs, consecutive lower highs, and most recently relative lows on the Dow Jones Industrial Average. But if I change on over to the S&P 500, you can see the most recent lower low over here in the months of January and February. The primary trend direction, unfortunately for the bulls out there, is to the downside. I'm just simply relaying what I'm reading as per the technical charts right now. So again, on the S&P 500, you can see that similar double bottom. People are calling this W for winners, as if it's the resumption of the long-term bullish uptrend. That is incorrect, and I need you to understand that. Our price projections on the S&P 500 are back up here close to 2,000, and if we align that with the NASDAQ, you can see up here we have some open gaps. Now, open gaps generally fill, much like individual stocks or ETFs. When you see an open gap, and I understand the NASDAQ gaps quite considerably, just like we did in October, for instance, when we got this major gap to the upside, well, it just filled a month later. But what's most important right now is that when we saw the breakdown in January, we started to see again these big gaps, and we actually haven't refilled them. So as we're looking at these double bottoms on the Dow Jones Industrial Average and the S&P 500, we've got these price projections on the NASDAQ, even as high as 5,000. Now, I don't think the market is going to get up as high as 5,000. I'm looking more so at 4,900 until ultimately we see that roll over. Now, I will update you on this as the markets obviously progress. Again, I'm short-term bullish, but long-term bearish. I've got long-term positions already established in the market as far back as 17,633 towards the beginning of November when we saw this rollover. That was the first time which I personally was speaking to people in pro and taking on these counter trend or at that point in time, primary trend reversal types of trades, which we've added to at 17,126, and they were hugely profitable down here at 15,500. I haven't sold out of those trades. I'm holding on to them, and what I'll be doing is adding to my original shorts again at 17.6 and 17.126 when and if the market pushes on up, maybe even as high or even as low, as 17,000 on the Dow Jones Industrial Average. So although again I'm looking at this market bullishly short term, I'm not partaking in the bullish rally. In fact, I'm just looking to once again increase my hedge to the downside and make the most of what is probably going to be a very ugly market for the year 2016. Again, I'm just dropping the truth and speaking the truth in full transparency. It may not be what you want to hear, but it's what you need to hear given, of course, the predicament which the financial markets and global trade is currently in and what it means for, the financial markets globally for the year 2016. The US markets have held up relatively well compared to most of the other markets or global markets at the moment. But again, once we see, or as at Friday anyway, the S&P moved out of bear market territory. We did close back above that 20% correction from the all-time high over here, going back really to May, April on the S&P 500. But what's most important is that you just understand the ebbs and flows of the market, and this is nothing more than a counter trend a sort of intermediate movement back into the primary downward trend. Now, if you want to learn more about this, I'd encourage you to jump into Pro and have a look at that, because I go through this in much more detail each and every weekend, and those recordings are kept up on the website indefinitely. At the moment, I think there's 8 or 9 classes dating back about 2 months of 90-minute analysis per class, which you can go through and have a look. Now, what I wanted to do again to make this even more real is to jump into a couple of trades, because I've made this very obvious to students in the class or in that Pro class, and just to say, well, if that hasn't really got your heart sort of beating on the financial markets to hear this type of analysis, again, I'm not here to fearmonger or to sort of stress anyone out. It's just what I'm reading as per the technical charts. And, you know, people follow me and have been following me for quite some time, and I'm pretty spot on when it comes to technical analysis. But when I transform this and sort of relate it through to individual companies, when I'm looking at the price of Amazon, I'm expecting this stock to move up to about $600. This will coincide with the market moving higher. But once that ends, and once this bullish move ends, then we're looking at prices maybe in 3 months' time. Amazon down here at $385 a share. So we'll just round it up to $400. Let me just take that off the screen. And let's just say Amazon rallies up to $600 before then. So let me just, clarify this. Moves up to $600. If and when that happens, the next movement is coming down to $400 a share. Now, that's going to be a $200 write-off on the price of Amazon, most likely within about 2 months. Now, I'm going to sit here and say that there is a large degree or high probability that this will finish, or this will actually occur before the end of June. I can confidently sit here and say that 400 or even below 400, the target actually comes in again at 385 on Amazon, is going to be a fantastic little trade for us when, of course, the trade presents itself fully. At the moment, it isn't ready 100% yet. I can see the beginnings and the formations of this trade, but 385, that's a huge downside potential, especially if you're trading put options. Now, that is a very highly probable outcome for the price of this stock. It has been one of those FANG stocks, Facebook, Amazon, Netflix, and Google, which were the final sort of 4 to sort of capitulate and roll over. Because if you look at the Russell 2000 or the Dow Jones Transportation Average, these markets are already in confirmed bear markets. And these last 4 major tech companies are the last ones holding up the NASDAQ. And once this little bounce finishes, well, then you're going to see the true selling pressure, the supply flood the market, and these stocks are absolutely going to get belted. Amazon is number 1 again, 385 from 600. You're looking at about $215 of downside profit on derivative contracts, but only when the trade itself is ready. Just think about that and just let that sort of resonate with you for a little bit. Again, on some of these other stocks, Baidu, if I change out to the weekly chart, you're looking at Baidu coming down to about $80 or $70 a share. I'm expecting this to bounce up to about $180, and then you're looking at about, about $110, $120 to the downside on Baidu as well, which is going to be a fantastic trade. And also one of these other trades which we're keeping a very close eye on is Tesla. Now, when Tesla cracks this level, we're coming all the way down to about 120 first of all, and then all the way down to $100 a share. But before we get there, we're going to see the price of Tesla most likely move back to about $200. So we're looking at banking another $100 to about 120 on the downside of Tesla when, of course, this recent bounce in the equity markets concludes. Now, this isn't only prone or only sort of evident and valid to Amazon and to, say, for instance, Tesla. If you have a look at Netflix as well, this is a very overpriced stock. And once this global or this macro support area holds, we're looking at Netflix even coming down to $50 a share, to where this open window is still open. And if we see this bounce up to 110, 120, and we're looking at a long-term price projection down at 50, well, that's $70 getting written off, and you can do the percentage terms. This is going to look something like this. Now, again, this may shock a few people in this class. I'm not doing it for that reason whatsoever. But again, if we just zoom out and have a look at some of these long-term charts, the markets, the writing's on the wall, so to speak. The divergence, the lower low, the first lower high, this is all macro, of course. And of course, the most recent lower low, we're just running with the ebbs and flows of the market, and we're more or less, in a confirmed bearish trend. Global growth is, at recessionary levels. The Baltic Dry Index are at lows which we've never seen in the history of the index itself. Industrial production is contracting year over year. It's just horrible out there. And mainstream media aren't reporting any of this whatsoever. And when I couple this, very simply, with even the monthly MACD, now I haven't done this in this particular video, and this is what I'll do to conclude this. If we just, zoom out and show you this, and I just take the annotations off the chart, let me just ask you the question right now. What has happened in the past, 2 decades or since the turn of the millennium, where we've seen the MACD give us a sell signal. We've had one in 2007, 2008. The last one was 1999, 2000, the dot-com bubble, again at the start of the millennium. I'll bring up the S&P 500 because it presents the dot-com bubble a lot better. But you can see the top coinciding with the MACD cross. You can see the 2007 top coinciding with the MACD cross. You can see the 2015 top. What's it doing? It's coinciding with the MACD cross. This is the monthly chart, and none of these indications are bullish whatsoever. So again, when we're looking down and coinciding, working in conjunction with these lower time frames, sure, on the weekly chart, we are a little bit oversold. And again, we've got two hammer types of candlesticks at support. And again, this is sort of leading, to our suspicions at least that this market is going to bounce before we see the inevitable, sell-off and next leg lower. But when this support level breaks, you need to beware. You need to be hedged. You need to be hedged before we even break the support level. And we've got some very nice targets in that pro analysis class and a lot of analysis and research behind it, which is going to set a lot of people up in that class to really do well and to sort of make something positive out of what is most likely going to be quite a negative year for financial markets. Now, again, I have no control over that. I'm just reporting on it and just bringing you the technical picture because it's very clear to the trained eye. And it's sort of, you can see this coming a mile away. Before we saw the August breakdown, we were waiting for that very, very same breakdown when the market itself started to establish these lower highs. Since then, the picture has more so deteriorated. And here we are. This is really the final rally, as I've alluded to already, until we see the major sort of momentum movements where the bulls really throw in the towel and you just see supply flood this market. All right. So I just wanted to update you on Monday because, again, I can just imagine, the euphoria or at least the hope flowing back into the financial market, seeing the pre-market up 1% and seeing at least the Dow Jones Industrial Average potentially trading at, highs we haven't seen in about 2 months. And that's all well and good. But again, just make sure you understand the bigger picture because the bigger picture, of course, trumps the minor level and the molecular level, which a lot of people, unfortunately, are focusing on a little bit too much right now. So just think about that. And if you have any questions whatsoever, email me, success@pivotpoint-trading.com. If not, I'd encourage you to have a look at that pro analysis class because, again, this is really a critical moment or at least a critical time in financial markets where a lot of people are going to do very well for themselves if they know what to do and how to sort of trade a potential bear market, how to hedge and what to do at certain areas on the chart counterpart to people who have their head in the sand, so to speak, and are holding long-term trades bullishly, which, are about to get more or less, put under severe water and severe stress, as I've already alluded to, say, for instance, on Apple, almost being halved in price in a matter of 3 months, which I can see happening very, very quickly. The continuation of the downside trends in Tesla and Netflix. And even IBM, if you have a look at this particular stock, a couple of months ago, we were trading at 170. If you go back a couple of years ago, we were trading at 200. The stock of IBM at the moment is struggling to keep above 130 at the moment. So you can see almost there, 45% of the stock has been written off in a number of years. And really the worst isn't here yet for a lot of these companies, and they're only just starting to turn. You have a look at the financial stocks. Goldman Sachs and a lot of these other banking stocks are under severe pressure. They are in bona fide downward trends. You can see these lower highs and lower lows. If you pay attention to Deutsche Bank, ticker symbol DB, all right, Deutsche Bank, the biggest German bank anyway, one of the biggest derivative, exposures in terms of derivatives outside of JPM or Citibank, their stock price, I can bring it up for you right now actually, and I'll just show you this. Deutsche Bank at the moment is sitting at 25-year lows. It did go through sort of a 1-week bounce, but you have to ask yourself the question, why is Deutsche Bank under so much pressure when we've already moved below the 2008-2009 GFC lows? Now, again, I'm not sure if Deutsche Bank is going to be the first bank to sort of fail or be the first domino to fall. There is a lot of stresses in the Italian banking system or the financial institutional system in Italy and Europe for that matter, but also outside of that geographic area, you've also got the Chinese shadow banking industry, which is under a lot of pressure due to deflationary pressures around the world and the collapse, of course, in the Chinese economy. All right, so this is just potentially one of the catalysts which has sort of become a little bit more pronounced over the past couple of months. It doesn't mean that Deutsche Bank has to be the first bank to sort of fall. There is a lot of stresses in at least the credit markets at the moment. There is contraction occurring, and generally a very good forward-looking indication of equity market and equity market values is whether or not the credit market itself is expanding or contracting, and it's a very good forward-looking indication. When you see the credit markets contract, all right, it's a very good precursor, at least warning that the equity market is soon to follow. And even if you pair the Dow Jones Industrial Average with the transportational average as well. Well, the transportational average is in a bona fide, again, bearish market. It is below 20%. It moved very close to 28%. You've seen a bounce take place, but this is nothing more than a retest of this old support level, which is now going to act as resistance, just shy or just under 7,750. So we're just seeing that natural back test, that 1, 2, 3 back test, before the primary bearish trend continues to the downside. This is just a few things to think about. Moving into the week. And again, the markets move quite slowly because we do operate on the daily time frame. But when we get into the clutch moment and into that right area, when we start to see the true reversal signals take place, the candlestick set up, and the MACD indicator, which is the main signal right now, when you see this MACD indicator turn down from the signal line, most likely it's going to coincide with the market top around 17,000. That's when you really want to be taking on hedges, or at least really saying to yourself, look, I need to make some serious decisions right now because I'm not going to have another opportunity until this market is priced a lot lower. And that's just the reality, unfortunately, which we're sort of operating in, early on in 2016. So just think about that anyway. And on that note anyway, I want to sign off. It's James, of course, signing off on behalf of Pivot Point Trading. If you have any questions, write them below. But again, I hope you found that a little bit educational and, worthy of your time, at least if you listen to that little presentation throughout. All right. So have a fantastic week, everyone. And I'll see you this weekend in that pro analysis class. All the best, everyone. Have a fantastic week. Goodbye.